Presenting this week's weekly market update is Jeremy Roosh, Jimmy Burnworth, Henry Poulton, Alex Layton, Johanna Hawkins, and Kevin Fulmer. We will give an overview of current market conditions while highlighting several significant transactions and developments. There were several interesting financings in the public markets recently. One of these was a convertible issuance by Titan Machinery, an agricultural and construction equipment company. Titan announced a $135 million issuance of 3.75% convertible senior notes. The notes will enable Titan's investors to convert a corporate bond with a 3.75% semi-annual coupon into approximately 23 shares of common stock per $1,000 of face value in 2019. Other intriguing developments in the public markets were evident in the highly successful IPO of Splunk, a tech firm providing cloud computing and data storage solutions, and relative inactivity in the corporate credit markets. Splunk is one of several recent tech IPOs, including Proofpoint and Infoblox. The markets are responding favorably to tech IPOs right now, and this public equity market segment looks to continue improving as Facebook prepares for its public debut next month. The corporate credit markets, however, have been more quiet than usual. Some analysts speculate that the lack of significant investment-grade corporate issuances may be attributed to sufficient debt issued through the first quarter of the year and a potential blackout period ahead of first quarter earnings.
Here is the merger and acquisition highlighted developments for the week. On Monday, Infosys company executive announced Infosys is poised to spend up to $500 million in a single purchase in Europe. On Tuesday, Groupon completed purchase of Bit.me, which is a social recommendation app. The amount was not reported. Toshiba Foreign announced they will acquire retail point-of-sale business of IBM. Deal terms are $850 million in cash. Wednesday, Audi agreed to buy Ducati. Details were not disclosed, but reports estimate $1.2 billion. Also, Conagra Foods Incorporated has agreed to buy Odam's Tennessee Pride, the second largest maker of frozen breakfast sandwiches in the U.S. The amount is undisclosed. On Thursday, XSC Health announced they will acquire Catalyst Health. Deal terms, cash and stock valued at $4.4 billion. ING announced they are divesting their Asian asset management unit, and Friday, the U.S. Airways proposed merger with American Airlines has been approved by the unions involved. However, the merger is yet to be certain. Finally, Pfizer infant nutrition unit continues under a bidding war, with most recent bid from Danone for about $11 billion.
Several reports that were released this week unveiled a slowdown or stalling of the U.S. economic recovery. Falling home sales plagued the market as existing home sales fell 2.6% in March. The Department of Labor reported that the 4-week moving average of initial jobless benefit claims rose by 5,500, the highest level since late January. The International Monetary Fund raised its forecast for global economic growth to 3.5% for 2012. Up from a projection of 3.3% in January. It raised its forecast for U.S. economic growth to 2.1% this year and 2.4% next year. Additional reports show that the Eurozone swung to a trade surplus in February on the 4th consecutive monthly increase in exports, improving hopes of an economic turnaround for the troubled region. However, IMF chief economist Oliver Blanchard said, "One has the feeling that any moment things could get very bad again." That feeling arose because Moody's is considering the downgrading of Eurobank ratings, which would further cripple the struggling market by causing funding gaps, increased collateral calls, and higher borrowing costs. Over 100 banks in 16 European countries stand to be affected by the changes in rating. In Asia, Japan released reports stating that it had a trade deficit with China in March at 5.9%, but a surplus with the United States at 23.9%. And lastly, the Fed had announced that banks would be required to abide by the Volcker Rule within 2 years. The new rule seeks to limit those risks taken by U.S. banks, namely restricting a bank's ability to trade with their own money.
Regulatory news for the week. On Wednesday, the Commodities and Futures Trading Commission voted to change the swap dealer bar. The original bar of $100 million from 2010 had been subject to significant criticism. The new bar, set at $8 billion, will result in an estimated 175 firms that will be required to register as swaps dealers. These swap dealers will be required to post margin on all trades and will also be subject to ownership restrictions and capital requirements. In contrast, the higher threshold will come as a great relief to smaller companies, as the imposing regulations would have been extremely expensive for them to handle. This rule is scheduled to go into effect 60 days after deliberation. In other regulatory news, the SEC voted Thursday in favor of bringing administrative action against Egan-Jones Rating Company. The allegation in question ties back to supposed material misstatements that applied to bonds issued by countries, U.S. states, and local governments back in 2008. Egan-Jones is denying the accusation and will stand by their claims of accuracy, also citing that such actions would counter the movement by the government for increased competition in the rating industry.
Moving into the most important investment banking news, Goldman Sachs Group announced on Tuesday that they will increase the firm's dividends for the first time in 6 years. The announcement came after the firm's net income fell to $2.11 billion during its first quarter. The dividend payout will be increased from 35 cents to 46 cents per share and will give an additional $200 million to shareholders and increase Goldman Sachs top executives' compensation by an additional $6.2 million. The higher dividend will be effective June 28. Bank of America announced that profits and loans outstanding fell 68% and 3% respectively from 2011. Regardless of the profits decline and latest news, Bank of America still shows a strength in the industry as it does business with 1 out of every 2 households in the U.S., and its fixed income trading revenue was up by 10% from last year. On another note, Bank of America directors agreed to a $20 million settlement in a lawsuit alleging shareholders were not fully informed during the acquisition of Merrill Lynch. This recently proposed settlement is being challenged at the moment by a separate group of shareholders as being too small. JP Morgan, the nation's largest bank by assets, announced earnings down by 3.1% as legal expenses and debt-related charges were taken into account. Morgan Stanley reported on Thursday a loss of $94 million after a $2 billion accounting charge. Excluding this charge, the New York firm is optimistic and said earnings in operations were $1.24 billion and up 55% from last year's. Citigroup reported profits fell 2% from last year. Also, shareholders rejected a compensation package for its senior executives that boosted the CEO's pay to $14.9 million after he collected a salary of just $1 in 2009 and 2010. Shareholders said Citigroup's plan failed to link pay to performance. In regards to new products introduced by investment banks, news highlighted that over the past several months, investors have bought bonds backed by unusual assets. Some come from revenue from Domino's Pizza franchises, Miramax films, patents for drugs, and even loans to buyers of vacation timeshares. There has been $5.6 billion in deals done, and the deals show that investors are becoming comfortable again with Wall Street's engineering skills. These securities also have better histories. None have ever defaulted, according to Standard & Poor's. Dealers on Wall Street are competing for this business as investors are more interested because of the higher returns that offer.
The S&P 500 index rose 0.6% for a year-to-date total return of about 10.3%. Japan's Nikkei ended the week down nearly 1%. Strong earning reports from a broad range of industry players provided a positive market for early traders. Blue chips McDonald's and General Electric both performed well because of positive responses to their latest quarterly earnings. Microsoft said it posted a 6% increase in revenue despite a sluggish consumer market for the PC. Microsoft's revenue for the fiscal third quarter rose to $17.4 billion. Although Microsoft put together an impressive performance, it wasn't enough to offset weakness in Apple. In the last 2 weeks, Apple, the world's largest, most valuable tech company, lost about 5.3% of its value. The stock is currently trading 11% below the all-time high it established earlier this month. Ford Motor Company said it would build its 5th car factory in eastern China as part of a plan to double its production capacity and sales outlets in the country by 2015. The Commodity Futures Trading Commission announced a $14 million penalty, its largest ever in an oil manipulation case and its first in 5 years. The dollar ran into some rather tough selling that caused it to lose 0.9% for the week. Most of that downturn was due to renewed strength in the euro, which climbed to 0.6% on Friday at about $1.32. Despite weakness in the dollar, commodities had another negative week that saw the CRB index fall 0.5%. The CRB had suffered 5 consecutive weekly losses for a total decline of about 5%.
Brian Kim of Liquid Capital Management was sentenced to 15 years in prison after running a $6 million Ponzi scheme for 8 years. Kim, a highly touted derivatives expert, invested in the highly speculative futures contracts that led to massive losses. He tried to hide his losses by sending investors phony monthly statements showing that their accounts had inflated gains of over 240%. Private equity firm Carlyle Group is looking to raise between $701 and $762.5 million by selling about 11% of itself in an IPO in early May. They're looking to sell 30.5 million shares priced between $23 and $25 per share. The green shoe option includes 4.5 million more shares. Carlyle plans to use the proceeds to pay down debt and finance operations needs, acquisitions, and new fund commitments. Most private equity firms haven't fared well in the public market so far. Blackstone Group, the world's largest private equity firm, has lost about half its market value since its IPO in 2007. In March, private equity firm Apollo Global Management submitted a bid to buy water park operator Great Wolf Resorts for $5 a share. Great Wolf, based in Madison, Wisconsin, operates 11 indoor water parks in the U.S. and Canada. In the following month, the bidding war escalated. On April 18th, Apollo raised the bid to $7 a share to match rival bidder KSL Capital Partners. On April 19th, KSL raised its bid to $7.25 per share. On April 20th, Apollo raised the bid to $7.85 per share. As of today, KSL said it would not outbid Apollo. The $7.85 share price that Apollo will purchase Great Wolf is over 50% above its original offer of $5 a share. And that's our presentation. Thank you.